All right, so now we want to talk about Chapter 11, bankruptcy. So Chapter 11 is a reorganization. It's a way for a company to stave off the creditors and operate while figuring out how to reorganize their business to where it can continue in some way going forward. It says here creditors are encouraged to negotiate new terms with the company. Yeah, normally, I mean, you're not going to see a lot of that one-on-one unless the creditor has quite a bit of leverage, such as if they are a large secured creditor or partially secured creditor. But the smaller creditors, they don't have much power. Unsecured creditors, you know, what you're going to do here, if you're that kind of creditor, is wait until you get the plan of reorganization and see if you get more in the Chapter 11 bankruptcy plan, reorganization plan, than you would in a Chapter 7 liquidation. So that's really kind of the thing that you weigh if you're the creditor. You want to see if you're going to get more in a Chapter 11 reorganization than you would in a Chapter 7 liquidation. And if you will, great. If not, there's no reason for them to reorganize. Let's just liquidate the business and move on. Now, once a company files for Chapter 11 reorganization, they are what's called a debtor in possession, meaning that the management that brought them into bankruptcy normally run the company after the filing of the bankruptcy, which is kind of ironic. And only in cases of gross negligence or mismanagement would the trustee look to replace current management. Now, you know, current management at the time of bankruptcy doesn't necessarily mean current management coming out of bankruptcy, so they may be two different things, but at least at the beginning of the filing of the Chapter 11, you're usually going to end up with the same management team that brought them into the Chapter 11. Yeah, creditors taking over as new owners, that doesn't happen very, very often. Matter of fact, seldom, if ever. Workers do keep their jobs. Suppliers do keep their customers, although, you know, if you've been left holding the bag with this company, you really have to question the wisdom of going forward and selling to this company in bankruptcy on credit terms. And so something will have to be worked out. Otherwise, you're going to have a bunch of suppliers who want cash up front, and a surefire way to kill a reorganization is to start demanding cash in advance. It just kills the company's cash flow. So somehow, some way, something has to be worked out. Of course, you know, if a supplier does pay them or does supply them with goods or services post-bankruptcy, those are treated as unsecured preference items, administrative items. So, well, not administrative, but unsecured. Well, not even. Let's see. Where would that fit in? Let me look back. Yeah, obligations arising between the date of the petition and the appointment of trustee. So, bottom line is that stuff's got to be paid after the bankruptcy going forward. So I mean, there's some assurance in that, but still, you know, from a supplier standpoint, why would you want to potentially dig yourself a bigger hole? And so management continues to operate the company while working out formulating some sort of plan of reorganization, as it's called. And within 120 days after the filing of the bankruptcy, they have exclusive right to prepare and submit a plan to the creditors and the court. If a plan of reorganization is not submitted within either 120 days after the filing or approved within 180 days, then any interested party can submit a plan of reorganization. Now, these time periods can be pushed back if the debtor in possession asks for more time, and invariably, you know, unless you've got some sort of prepackaged bankruptcy, you know, where you've worked it out with your creditors beforehand, 120 days happens really quick. So it's not uncommon to ask the court for extensions, and at least if there's a plausible reason for giving the extension, certainly the court will. But feasibly, after those dates, any interested party could file their own plan of reorganization. Now, what's in this plan? Well, it varies from company to company, obviously, depending on what the situations are, but usually they have the following characteristics. They usually propose changes in the company's operations. Certainly there might be changes in the management structure or management personnel. Usually there's maybe some additional financing options. So those are discussed, and really the biggest part of the plan is the organization's plan for settling the debts at the time of the bankruptcy. And so, as the book indicates, there's several ways that can be done. Certainly, a large one that happens a lot is these creditors are offered less than the amount of their debt, certain percentage, if you will, of their debt is paid. They could be offered equity in replacement of their debt, so they become a shareholder and share in the profitability, future profitability of the company, if any dividends, things like that. Now, several things have to happen for this plan to move forward. First of all, it has to be accepted by creditors. Not all of them, but a large part of them. And so, as far as creditors are concerned, 2/3 of the dollar amount of each class and more than 1/2 of the creditors within each class must vote to approve the plan. So you might ask yourself, well, what's a class? Well, again, that kind of depends on how the debtor in possession wants to set up these classes. It might be a class of certain unsecured creditors whose debt is $10,000 or less, and then they might have a different class from $10,000 to $50,000. You know, they could set up different classes however they wish, but usually there's some commonality between creditors in each class. Now, again, what would cause someone in a class to either vote for the plan or vote against the plan? Well, again, it goes back to what they might receive in a liquidation, or what they would receive in a liquidation versus what they would get in this Chapter 11 plan. And usually they have to receive more in the Chapter 11 plan than they would get in a Chapter 7 liquidation. I mean, that's kind of the threshold. In addition to each class of creditors approving the plan, 2/3 of each class of stockholders who vote must approve the plan. Now, on top of that, the court must confirm the plan. So even if 2/3 of the dollar amount and more than half the creditors who vote in each class approve the plan, and even though 2/3 of each class of stockholders who vote approve the plan, the court may not confirm the plan. What makes a plan confirmable versus not confirmable? Well, the court looks to see if the plan is feasible. Well, what does feasible mean? Well, if there's a better chance than not that the plan will work. Okay, so it's not a surefire guarantee that the plan will work, but more likely than not, the plan will work. So that's what the court's looking for. Now, the court can also force acceptance of a plan that's voted down by one or more of each class who has a right to vote for it. And so this is known as a cram down. And so what is the criteria there by which the court would approve it, even though some creditors, some classes of creditors or stockholders did not? Well, whether the plan of reorganization overall was fair and equitable. What does that mean? It's a good question. Don't know. But usually it means they're getting more than they would have in a Chapter 7 bankruptcy. The court could, rather than confirming it, if they don't believe it is feasible, they could convert it from an 11 to a Chapter 7 liquidation. And they can do this at any time during the reorganization process if it looks like a reorganization is not going to occur. And usually this is based upon something that maybe the U.S. trustee tells the court through some application. Usually they'll file a motion to convert it to a 7, saying for whatever reason, they don't feel that this should move forward as a Chapter 11 bankruptcy. So that could happen at the time of this confirmation hearing, could happen sooner, depending on the circumstances. Now, how do we account for a company that moves through reorganization? Well, while you're in the reorganization, you have different things that occur. So the following questions arise. You have differentiating income from operations that you have to keep the income from operations separate from transactions connected to the reorganization. So you have to segregate those two things. Usually, as far as debt is concerned, you're going to list those items that are pre-petition debts, separate from debts occurring after the petition. And so the pre-petition debts usually are categorized as liabilities subject to compromise, and you just list them at whatever value of their claim. And so FASB has issued some standards here for dealing with financial statements to be prepared during the reorganization, as well as when the entity emerges from reorganization. And so gains, losses, revenues, and expenses of the reorg are reported separately from normal operations on the income statement. Income on the debt, the pre-petition debt, doesn't accrue, but because you've probably filed at a time when you've strategically planned to have a bunch of cash, you're probably going to have interest income on that cash that you're holding, and so you're going to have to report that as a reorganization item, not an operating item. As far as the balance sheet is concerned, you report assets at book value just like you did before. As far as liabilities are concerned, current versus non-current classification is no longer applicable. And again, those liabilities should be reported separately at the amount of their claims. Now, liabilities not subject to reduction are all shown as current versus non-current. That would be the operating liabilities during the operation of the reorganization, not pre-petition. Now, as far as what happens if a company, their plan of reorganization is approved, and so you have to look to see if the reorganization is considered subject to what they call fresh start accounting. And so when a company emerges from Chapter 11, GAAP permits this fresh start reporting if two conditions are met, and usually they are in a Chapter 11 bankruptcy. The reorganization or market value of the assets are less than the total of the allowed claims as of the date of the order of relief, that's the date of filing, plus any subsequent liabilities. That condition almost always occurs in a Chapter 11. Also, got to meet both conditions. The original owners are left with less than 50% of the voting stock. Again, both of those conditions are normally met in a Chapter 11, successful Chapter 11 bankruptcy. Now, if both of those conditions are met, this company qualifies, this company coming out of bankruptcy with a court-approved plan of reorganization, qualifies for fresh start accounting, and so that means the following. The company's assets are restated to individual current value. So normally what they're going to do before they even do that is they're going to ask themselves what the fair value of the company is as it emerges from reorganization. What a willing individual or other company would purchase the reorganized company for. And, you know, they talk about the difficulties in that, but certainly it can be done. So, and this sounds very familiar. I mean, it's just like we looked at with acquisition, the acquisition method of accounting. What is the consideration given for the company, right? And then you have to take that consideration and apply it to each asset restated to an asset's individual current value. If you have assets that haven't been included, you have to add those. And so I think they have in the book an example of a trademark. Recall that if you if you purchase a trademark from another, you get to include that trademark on your books. But an individually, internally generated trademark is not listed ever as an asset, right? So here, if you have such things, you would get to value those and put them on your books at the current value. So that's just like acquisition accounting. Liabilities, except for deferred income taxes, are stated at the present value of future cash payments. And so usually that's going to be a heck of a lot less than what the original claims were, by the way. And normally these adjustments to liabilities are going to be made, as well as adjustments to the assets stated at current value instead of book value, are going to be made offset by an adjustment to additional paid in capital. And then at the very end, you're going to take a portion, if not all, of additional paid in capital and close out, well, offset that against retained earnings, because since this is a new company, retained earnings starts at zero. So what I would do is I would look at the example in page 606. And so in that first entry, what they do is they mark up the value of certain assets, not all of them, but certain assets, and any excess value of the company over the excess to designated assets is considered goodwill, just like with the acquisition method of accounting. And the offsetting credit is to additional paid in capital. Now the next entry deals with 35,000 shares of stock at $1 per par value that were returned by the company's previous owners. And so the offsetting credit there, again, is to additional paid in capital. Next, you're taking your original accounts payable amount plus accrued expenses, and those are to be paid out in a notes payable. And note here that any difference between the two, your debits and credits, goes to a gain on debt discharge. So what they're doing there, they're exchanging $60,000 of accounts payable plus accrued expenses for a notes in return for a note payable to all those creditors for $70,000, the note payable over a year. Well, and the difference is $40,000, which is going to be a gain on the debt discharge. Then you go to the next one, almost finished here. Notes payable, you're exchanging a note payable for 3 years, terms of 3 years, for a note payable for only $100,000 plus some stock and the note payable is for 10 years. The common stock is 20,000 shares, they're getting additional paid-in capital of 40% of the total additional paid-in capital of 250,000. So 100,000. And the difference there goes to a gain on debt discharge. And it's the same sort of thing with the bonds payable on that next entry. And then what they have to do is they have to end up with additional paid-in capital of 250,000. And they have to close out the gain on debt discharge. And they also have to end up with 0 retained earnings. So they're going to, they have a retained earnings deficit here. So they're having to credit retained earnings, since it's a deficit, to zero that out. They're reducing additional paid-in capital down to 250,000 by debiting 200,000 excess. They're at 450 before this entry. They need to get down to 250. And then they have to close out that gain on debt discharge. So if you add up all the gain on debt discharges they have here from the previous entries, you come up with 80, 80, and 40, so that's 200. So they debit gain on debt discharge for $200,000. And so they give you the what the trial balance would look like after all those entries are made. And you notice that we've got a new company here with new capital structure, no retained earnings, new debt, new values on several of the assets. So literally it's a brand new company going forward. So anyway, that's Chapter 11, bankruptcy or reorganization.